Hi, good evening, guys. Thanks for your patience. My doctoral course ran a little long. Talking about strategic planning and making investments in university endowments, because they are people who make some of those decisions and they don't know anything about markets. So this could be interesting. I got a note from Dr. Tharp this morning. He's asked me to prepare some research material for applying Professor Fletcher's creativity to trading, which is good because I'm building that in Creativity 202. So we'll be able to test fire that in the new workshop that he's putting together. All right, so what we had today in the market health check was the market just refused to lose. So yesterday that move had taken it to a new high. Today we added more, new 10-day high, new 30-day high, new all-time high, and pushed all the way up to vicinity the Z2 line. There is no resistance overhead, and the only thing we have is mathematical resistance at Z3 at 477. $50 ago, we were wondering at 410 what to do with a market that was so obviously overbought. It turns out that you just you keep following the rules and managing your risk, and the upside will take care of itself, is what you do. So given this move, where do I have the stop, my swing stop? Is I have that like right here. Like I'm going to keep half it today. I'm not going to let it go below that line. I could understand the 1 bar low, I suppose, or the edge of the dragon, spine of the dragon, lower skin of the dragon. Here's the 2.5% sell-off at 453. There's that's also tomorrow's Psar. Here's the Bollinger Band mean all the way down here. But that, to me, it's this top level. It's that top level price. I want to keep this stuff locked in because we are at an extreme of goodness, and I don't want to give any of that back. I want to keep the yellow box, right? Because the yellow box represented something like way back here, it broke out of the Z2 and started running up this, following the Z2 line and staying north of the dragon. So that's been just an amazing run. And I don't want to give back the yellow box. The yellow box is mine. And I'll just keep following this up the stack as far as it goes, but ratcheting my stop as we go. That's my story, and I'm sticking to it. Let's build out our procedure here. The S&P. .61. Emerging markets, 0.47. Diamonds, 0.27. Treasuries off 1%. And the big winner of the day was tech at 1.06. And the grand champion, the Russell, 1.8. So that was actually the big winner of today. So this is telling you that it's all U.S. all the time. When the S&P was better than emerging markets and the Dow and the treasuries, that's telling you that large cap with growth is winning. And then the two biggest sectors were the speculative ones. Qs and IWM are dominating. So Peter asked me, can I recall a trend of this nature in the past? And what I'm going to do is call up the daily report. And what I'm going to do is I'm going to measure the trend on a historical mathematical basis for my recall, because I don't trust my memory, but I trust my eyes. And what I'm going to do is answer that question by the following. I'm going to look at, oops, got a little too big, stand by, fit page. And what I'm going to do is go look at some of these market condition things like right here. And what I'm going to do is take a look at the long-term RL30 slope, okay? And I'm going to look at the last 10 years. So I'm looking at chart 5, right? And my argument is that the condition of the market, the single best descriptor that I use, in my opinion, is the slope of the last 30 days. The RL30 is the best single line description of the price trend of the last 30 days, right? So charts 5 and 7 show the long-term slope of the RL30 in the context of the last 10 years. So here's what that means. When you look at Z1, that's the upper limit of normal in terms of the slope, and -1 is the lower limit of normal based on the slope. And here's what I mean by that. Let's see if my here's just a quick lesson. So if the price of the last 30 days was exactly flat, that means price has not improved in the last 30 days. I mean, you might have had price that looked like this and, you know, it's mucking around, but it's not really going anywhere. It's not doing much. So the 30-period regression line looks like that. And the slope of that is 0. And then if the price looked like this over the last 30 days, then the regression line would look like that. And so the slope of line A, let me draw a capital letter. The slope of line A is better than the slope of line B. And then that would be better than the slope of line C, which was, if it was losing money, it would look like this. And we don't want that unless we're short. So we can actually use the slope of the line to describe the quality of the price trend of the last 30 days. Well, why do I use 30 days? Well, because that's you need 30 data points to have any confidence in the quality of your statistical judgment. If you have less than 30 data points, then your statistics start getting weak. If you have at least 30 data points, you're allowed to start using statistics in a normal way. As you add more data, you get better fidelity of your description, but at some point, 30 days is a pretty good trade-off between not too much and not too little. It's just right. It's like the Goldilocks of data. So that's why I use 30 days. And then I make the argument that the slope of the regression line, the value of that allows you to compare how good is trend A compared to trend B, which is flat, compared to trend C, right? So now we have the basis of comparing 3 different trends. So now you asked me a question, when was this market ever behaving like it is now. So what I do is I just go to this chart and I say, what is the value of the slope of today's 30-day regression line? And it turns out that right now it is just above Z1. In the last 200 days, it was only this good one other time when it made this run. And now it has just been extraordinarily good. So that's pretty good. In fact, if I now go back 10 years, and for each day of the last 10 years, I compute the value of the slope. I calculate the regression line, and I record the numerical value of that slope. How steeply up or down was it? That's the question I ask. And so I go back 10 years. Well, there's 260 trading days in a year. So that means I'm calculating it 2,600 data points. And then I can rank that on the basis of the max and the min, and then the average, and then plus or minus one standard deviation. So I now have a statistical plot called a stem and whisker plot, or box and whisker. So it turns out that 1/3 of the time it's between average and +1, and 1/3 of the time it's between average and -1, and 1/6 of the time it's up in here, and 1/6 of the time it's down here. And what that means is that 2/3 of the data is we would consider as normal. So whenever it's between plus or minus one standard deviation, we could call that normal, and we could call this abnormally good, and we could call this abnormally bad. So here's where we are right now. We just went into abnormally good. And in fact, over the last 10 years, there's only been 1, 2, 3, 4, 5, 6 periods when the upward slope was better than it was this good or better. Yeah, I guess maybe 7. So this is already better than all of this market action way back here. It's only this recent response to COVID that has had this extraordinarily strong temporary trends up as part of a larger trend up. So it turns out that this was really an amazing move. So that's one way that I can answer your question, Pete. Can I recall a trend of this nature in the past? Yes. 5 times in the last 2 years coming out of COVID, we've had a 30-day period where the market was extraordinary like this. So go back and look at the daily and weekly charts of the market over the last 2 years, and you'll find periods of time where the market has had behaved like this, just crazy good. What makes this one exceptional is that it's pushing new highs. A lot of time when the COVID happened, you had this harsh sell-off of fear, and then you started having these sharp retracements that were good. Well, all of those are just getting back to normal. What makes this one especially interesting is the fact that this is now broken above all of that COVID highs. And so this is a market where the economy sucks. Inflation is horrible. War is on the horizon. Unemployment is crazy. COVID is getting worse, not better. And the administration are lunatics, asleep at the wheel if they're not demented. And yet, this is a market where volatility is declining by both measures, and the slope is upward. Tell me your theory of the market that explains that which also explains all the previous price action and still allows you to predict this market. That's how important I think having a grand theory of how the market works is. It's not that important, not important at all. If you are a tactical and operational swing trader that's using statistics and trading forward on the basis of price evidence rather than having a grand unified theory of how the markets work. Good luck with that. Tell me how that works for you. Well, here's another way that I can look at that too, is I'm going to go a little deeper into our daily report since we're here. And I'm going to take a look at the S&P on a the number of, or let me put it this way, the holding X period. So this part of the chart, let me get my annotation here. Stand by. So this part of the chart is looking at a 40-day holding period for all of these symbols. And I'm just going to look at the S&P just for fun. And what this does is this looked at the absolute value of the price today compared to where it was 40 days ago. And so it takes the price 40 days ago and compares it today and expresses that as a percent gain or loss. 40 days ago compared to today. And I do the same thing. I go back, in this case, 10 years, and I compute all of the 40-day holding periods. So this is, the one I just showed you was the use of the slope. This one is taking a look at the actual price appreciation on a percent basis. So where we are today is compared to 40 days ago, we are up 4.69%. The average of those 2,600 40-day holding periods is 2%. And the standard deviation is 0.05 or 5%. The best single 40-day period in the last 10 years was plus 31%. The worst 40-day period was minus 32%. When you compute the z-scores, the z-score of that horrible sell-off was minus 6 standard deviations. The z-score of this favorable one was 5.5 standard deviations. Today's standard deviation is only 0.48. So on a historical measure, on an absolute basis, the gains of the last 40 days are just half a standard deviation above the long-term average. So this isn't even crazy yet. Now, if you think about where we were with the slope of the 30-day, that's not even asymptotic. That was just now getting out of the Z1. So on a statistical basis, this is not a crazy market yet. It only is, it's just not explainable, but it's not asymptotic yet. That's how this market is. Now, that same logic takes you through the 20-day, the 10-day, and the 5-day look-back periods to compute all of those values. It will. So on that basis, Pete, I answer your question of, can I remember what it was like? Yeah, this is beginning to get my attention that it's starting to get crazy. And that explains why I am tightening up that stop on those swing trades, simply because the gains have been surprisingly, even abnormally good. And so under those conditions, I want to keep more of that abnormally good gain. Like, just if I look back at the last 180 days, for example, this little 30-day period in here was pretty good. In fact, if we go up and look at the Z-score, that 30-day period, the market looked like this. The RL30 had gotten to Z2, the slope. The RL90 had gotten to 1.5 Z, and the RL10 had gotten to a peak here. Well, you compare, where are we today? The RL90 has cooled off quite a bit, so it's not crazy overheated. The RL30, if we're being honest, is actually pretty good. So that's why I'm thinking like there could be a shorter term retracement here, just like there was here. And that retracement is where the market got it stopped getting so steeply up. Here's where it was very steeply up. And now in this period, it just got a little choppier. So this could still go up, but the chances of it becoming choppy now are greater now that it has exceeded that peak. So this is what we call the market mosaic approach to appreciating market conditions. Now, I know it feels comfortable to have one single metric for judging market type. There's a trade-off that you get when you do that. You're tying everything to one single snap judgment, and it may not give you enough nuance to fully appreciate what's going on. So, although I use point assessments, I also use this mosaic approach to help me get a wider and deeper appreciation of the dynamics of this market to help shape my worldview, my market view. And I spend this time on the market because if you get the market right, you got 50% of the problem solved. And then if you get a sector right, it's a 25%. And then the individual company is an additional 25%. Now, one of the reasons we were so excited about this was the RL30 had bottomed out when it broke through the bottom of the river and peaked. That's where we started getting interested. And this is where the COTA 2 entry occurred. When we talked about the COTA 2 and the SSC, you hear me talking about that all the time. That's where that occurred after this extraordinary sell-off. That extraordinary sell-off took you to almost C-2. Statistics are your friend. They're not hard, but you do have to pay attention to them. And that's why, to me, the slope of the regression line, the slope of the 30-period regression line is the most important single best description of the price trend of the last 30 days and why it shapes my view of market classification. It has an important part of my market view. So you need to know that in order to interpret what it is that I'm saying about the market. That's the lens that I'm looking through. So there we are. Back to our regularly scheduled program. Let me know if you found that to be helpful in the chat. If you found that helpful, please let me know so I can decide how to answer questions in the future. Okay, things that worked today. Let's take just a quick look at those. So you had clean energy and consumer staples. You had materials were better. Now you got tech. Now you have moonshots, ARC Genomics, wheat and precious. You have Mexico and the FANGs. You have consumer discretionary, ARC Genomics, blockchain. You have lumber and biotech. You have Brazil crushing it. You have lumber, the other lumber. And now you have the cluster, they have Ethereum crushing it. Simon Proper Group, a second day of strong follow through and a brilliant recovery now in Tesla and Robinhood up 5.8%, Tesla 3.6, Coinbase 2.4, US Steel 2%. Pretty good stuff. What got smoked today? Well, we have S&P Finance and lithium, agriculture, Bitcoin Trust, energy, oil exploration, minus 1%. Marijuana, Bitcoin futures, blended commodities. VXX is down. That bodes well for tomorrow's open. The blended large cap, crypto, and oil. What underperformed the individual companies? TX, the steel company, minus 14%. 14%? Wow, that was tradable. John Deere, 3.5%. Cliff Natural Resources, 0.13%, and Devon Energy. Probably an earnings or a news event. That sounds like a fire sale to me. Probably an overreaction. So that's going to go back into the rotation as a stock of interest as people recover from that murderous assault on their pocketbook. So lots to choose from for tomorrow. As we take a look at this this assessment of the things that drive the market, to me, the U.S. sector versus the global sector, it's all U.S. all the time. The cryptocurrencies are continuing to crush. Growth and disruptors in terms of style are getting it done. The large caps are dominating, but I must tell you that the small caps are really making their move this week. This is the week in which the rotation to small caps is really paying off. Take a look at IWM since Monday, and it's been dominating. It was up 2% on Monday, 1.8% today. It was strong yesterday. The small caps are getting the juice. And right now, the U.S. sectors are outperforming their global sectors. So that's my assessment of what's going on. And what I'm trying to do is use professional judgment where I respect art and intuition, but I really respect science, math, statistics, and I'm trying to use professional judgment to balance the emotional content of markets, the psychology of markets, and then the scientific description of markets. I'm trying to blend that into professional judgment that allows me to manage risk in an integrated way. A couple of charts from our systems thinking and creativity course. A quick look at the boys trading today. This is daily. This is Bill Scheit. So Bill Scheit just sent me his research paper for our research weekend for December, and it's his cryptocurrency Psar flip system. He's been doing Psar flips, and this is an example of one of those moves. And it's up 40% for the year in his retirement account. And here's what he does. And he's got his system rules defined and back tested and forward traded as part of that research weekend. He has he identifies this as a COTA 2 entry because he has a low, a higher low. Here's the Psar flip. So he buys it. There's a 1, 2, 3 exit right here. He takes the Psar exit right there. That's his trade. And that's 0.92R. Lather, rinse, and repeat. He could probably now set this up as a trade frame and trade that short, or he might take this one. He might wait for it to cross the dragon for an RLXD entry if he's a tactical trader. Okay. But nice work there. This looks like Luke. Harsh winter, Psar flip, buys the crossing, uses the risk box. Stop me if you've heard that before. Up, fails to fail further. Notice how the RL10 barely budges. So when it takes out the peak, buys a second position, a shelf is formed, the peak is exceeded, buys a third one. So this one gives him, is it 4.4? Yeah, 4.4 on Nucor Steel, a steel company. Ladies and gentlemen of the jury, I rest my case. Alcoa. Yeah. Oh my goodness. That one hurts my feelings. So there's a Kata 2. There's a Z3. There's a second position. That would be your exit. This is the short, or this is the short, or that is the short. This is a reasonable, and this would be your exit for that whole short position. That's a reasonable, perfect SSC, because what you're doing is you're front running to get in front of it if it crosses the VWAP. Because if it gets through the VWAP, you expect it to get to the peak of the dragon before it starts to roll over. And then if you get this one here and it gets through the VWAP and then gets through the RL 270 and gets past all this crap, this is where you put the second position en route to up here. But he takes a good exit. There was a Kata 2 reentry here to the long side because you have a low and a higher low. This one is late. We want to get that at like at a Z3 because you want to get long before it crosses the VWAP. But a good recovery, but that's your short signal, because now this is the high. That's your lower high, and it rejected the RL 270, and this is where it rejects the VWAP. That's your short. Oh. So this discussion here is about span of control and what your chart looks like and the ability to go between targets, span of control. This is a good effort and good trade. and a reasonable shot. So yeah, it was the trades not taken, not the trades that were taken. Truer words never spoken. Happy I was patient. Knew it was going to be quiet until the FOMC. Left a little on the table. So this is your sideways quiet channel. Oh, it's more than that. It's a Z3P, because notice that he's using the R factories, and where when it's abnormally narrow, it turns to yellow. In fact, the RL270 is in here too. It's not just a Z3P, it's a super pinch. The super pinch is like a radioactive acorn. And there's your first move up, hold and go. Beautiful entry. Reasonable capture of 1R. Beautiful reentry, good capture of 1.5. Good reentry and a nice capture of 1. Beautiful reentry on failure to fail. That is a measured way to get it done. So you got 1, 2.5, 3.5, 4.5. So 4.5R. And the conventional wisdom is don't trade on days that the Fed is making their calls, because it's too crazy, too wild. Notice how he's got this marked off, that when it's done with the summer run and heading into the fall, he chills out. Get them when they're running, when the season is good. Boy, that's just perfect. That's so perfect, we'll call that one pretty good. That's how good that was. Oh, and then not to be outdone, Luke just show it off now. Smarty pants. Here was the Z3 pinch. There's a collapsing dragon. There's your short. Here's a 1, 2, 3 exit. So I don't mind, I guess, getting here, but you know, it broke through the VWAP up in here. It broke through the RL270. You got to be at least getting short here. Then that becomes a scratch. But if you got short there, you'd take your exit in here and have a fractional win instead of a fractional loss. But you know, you managed to get long after it had crossed the VWAP. So that's really where you want your stop and reverse, don't you? And then that's your second position. And then a third position here with the fractional loss. So this one was worth 1.3. That would have made this one worth 1.7. You could have added almost another 2 full R. That's your Kata 2 reentry. This is not bad. That's a Z3 pinch breakout. Slow on the exit. A reasonable effort, good exit, a better short. Now you're at least getting it before it crosses the Bollinger Band mean. That's good. Collapsing dragon, second position. Third position, slow getting in, but I like it. You know, I like that third position here when it violates the VWAP, or here where it violates the RL270. But I like this one because it's a CD. So you got 1, 2, 3 positions in, and you stayed a little long on that one. Like if you go here, that's an extra +1R because you got a third of an R, but on 3 positions. So instead of 12.8, this could have been 13.8. Plus an extra +1 by better attention to detail. So this could have been a 15R day, but we'll take 13R. So 13 out of a potential 15 is about 85%. Pretty good. And these are good. Good scratch. A little slow on the Kata too, but that's pretty good. Richard, you asked me that question before. Would I use alerts to manage a trade? Yes. We teach how to do that. All right, let's go to the daily report. Head back up to the top. Let's see what we got. Overbought all the way across the board. Risk Z is dominating. The volatility is getting a little flaky, so that's why my stop is relatively tight, because it's starting to become abnormal. When you're making new 10-day highs, you're not going to get channeling and overreaction signals. New Core Steel, Simon Property Group, Home Depot. Still some reasonable auto framers. Today was an exceptional up day, so not much to choose from there. Still some auto framers in the ETFs. Clean energy and tech and Mexico and metals and mining are crushing it. IBM remains an interesting auto framer, as is Intel, has some catch up to do. Emerging markets also looking pretty good. Big winners today. Stay with the winners. Stay with the greens. You can be stalking the reds for short on failure, and that's where you're going to find value later on. But for right now, the fish are running. That's what the coyotes being an opportunist right now. All right, that's everything we got for today, guys. Thanks for your patience. I'll get this published and posted in the usual way. Thank you very much, and thanks for your good questions.